In the grand halls of the U.S. Treasury, a weekly ritual takes place that decides the fate of the global economy: the bond auction. For decades, the script was predictable. Foreign central banks, led by China and Japan, would snap up billions in U.S. debt, recycling their trade surpluses back into the safest asset in the world. But in 2025 and 2026, the script changed. The giants have left the room. China is selling, Japan is retreating, and the Federal Reserve is no longer the buyer of last resort. Yet strangely, the auctions are still clearing. The debt is being sold. But if the big players aren't buying, who is? Today, we investigate the demand gap, the invisible mechanics, and the high-risk players who are quietly keeping the American empire afloat. To understand the gap, we must look at who is gone. For 30 years, the global financial system was a closed loop. We bought goods from the East. They bought our debt with the profits. But geopolitical shifts have shattered that loop. China has slashed its treasury holdings to record lows, fearing the Russian treatment, the freezing of assets. Japan, fighting to save the yen, can no longer afford to be America's piggy bank. And most importantly, the Fed has shifted to quantitative tightening, actually shrinking its balance sheet. This has created a massive vacuum, a demand gap of trillions of dollars at a time when U.S. deficits are exploding to 5% and 6% of GDP. So, who filled the void? The data reveals a shocking shift. The new hero of the Treasury market isn't a central bank. It's the household sector and private domestic investors. But don't be fooled by the name. This household category is a catch-all that includes massive hedge funds and private equity firms. These aren't loyal allies. They are price-sensitive buyers. They aren't buying because they trust the dollar. They are buying because the yields have spiked to levels impossible to ignore. For the first time in a generation, U.S. debt is being treated like a credit risk rather than a safe haven. The U.S. government is now competing with corporate bonds and emerging markets for every dollar. But there is a darker side to how these auctions clear. Enter the primary dealers, the elite group of banks like J.P. Morgan, Goldman Sachs, and Citigroup. By law, these banks are obligated to bid at every Treasury auction. They are the ultimate backstop. When real money buyers, pension funds and foreign states, walk away, the primary dealers are forced to swallow the remaining debt. This creates a shadow inventory of treasuries on bank balance sheets. In 2026, we are seeing tails in auctions, moments where the price drops significantly just to find enough buyers. The market is clearing, yes, but it's clearing with a struggle, and it's clearing at a cost that is becoming unsustainable. The demand gap has a price: higher interest rates for everyone. Because the government has to bribe investors to buy its debt, it is pushing yields higher. This is the crowding out effect. When the government sucks up all the available cash in the private market to fund its deficit, there is less money for mortgages, small business loans, and corporate innovation. We are entering a cycle where the government's hunger for cash is making the rest of the economy poorer. The demand gap isn't just a technical glitch. It's a tax on the future of every American citizen. The U.S. Treasury market is the foundation of the world's financial house. For now, the house is still standing, held up by hedge funds, high yields, and forced bank purchases. But the demand gap is growing. As interest payments on the debt surpass the military budget, the margin for error disappears. The world is watching to see what happens when even the price-sensitive buyers have had enough. Can a superpower survive when it no longer has real buyers, only mercenaries and hostages? The answer to that question will define the next decade of global history.